Well, this is the last Watchlist Wednesday for 2020, and it's the first year that I did this, so I have to say, I'm very pleased with the way that this series has turned out, and I've been very excited to see all of you come along this journey with me. We've seen a ton of companies by now that I've done each week, and I know I've learned a lot from this process of analyzing these companies, and I hope that all of you have learned at least something from some of my rants throughout this series. Since this will be the last Watchlist Wednesday for 2020, I wanted to do something a little special this week. And by special, I actually mean incredibly risky. Today, we're going to be looking at a company that is very new to the public markets, is not profitable, and has a terrible balance sheet, but also has a ton of upside potential. Since you read the title, I'm sure this comes as no surprise, but the company we're going to be looking at today is FuboTV. Hey everyone, thanks for joining me today. My name's Matt, and before we get started here on Watchlist Wednesday, I just need to say, this is not financial advice, please don't take this as financial advice. If you do need advice, please go speak to a financial advisor, they'll be able to help you. This is just for your entertainment purposes only, so take everything I say here with a grain of salt. Also, not something I've really said in a while, but I wanted to mention, I did see Webull right now is doing a promotion where you get 6 free stocks, and it actually ends today, December 23rd. So if you want an account, I'll leave a link below. Sign up with them for 6 free stocks. You can if you want to. I know it's last minute, but wanted to throw that out there. Usually I don't, but that seems like an awesome opportunity. So check that out if that's something you're interested in. So if you're not familiar with FuboTV, they did start in 2015 as a soccer streaming service. They very quickly moved to an all-sports streaming service in 2017 and have recently adapted other forms of content, like things like your family TV stations like MTV, Food Network, Travel Channel, or HGTV, and have also been looking to incorporate news into their services as well. Now, since this is such a new company, I hate to admit it, but we don't really have too many numbers to look at for this company, as well as there's not really many earnings calls to dig through. So what I'm going to do for this week is I'm going to tell you what I like about this company, what I don't like, and their potential threats are, and then we'll make our decision once we run through all of that. But I do want to start off on a good note here and talk about what I do like about FuboTV. So as many of you know, I like companies that are able to hit a niche target well, and I think that's something that FuboTV has done. So take this with a grain of salt because I saw this cited and I couldn't fully dig into the numbers here, but I saw that 86% of content watched on cable TV now is a mix of sports and or news, mostly being sports. So obviously sports is something that many people still watch on TV. The thing is, your traditional content, shows like The Office, Parks and Rec, Friends, are now on streaming services and are less available on your standard cable TV channels. And it really did just leave sports and news behind, which I think left a huge area of opportunity for somebody to come in and take one of these kinds of services and make a streaming service out of it. And that's exactly what FuboTV did with sports. And they were able to do that by having large coverage of different sporting events. Basically, if there's a sporting event that you want to watch, there's a very good chance you'll be able to watch it on FuboTV. And I have a few examples to give you. So, as many as you know, I went to ECU for college, East Carolina, and while I don't really like talking about their football team since it's been pretty tough to watch these past few years, I'm still a loyal alumni, and FuboTV is actually one of the few places that'll actually be able to watch all of their games, even though East Carolina is in North Carolina, which is where I live. And the same thing really goes for people that move as well. So if you're from upstate New York and you're a Buffalo Bills fan, then you move to North Carolina, you might have to sacrifice watching your Bills play to watch the Carolina Panthers play, which might be a game that you do not care about at all. Fubo still allows for you to follow your teams that you're loyal to, regardless where you are, which is something that could be an incentive for people that are really loyal fans to their professional teams. And it doesn't just go for football. This is really covered across all professional sports. Another example I have is I used to play lacrosse. Unfortunately, with lacrosse, it's not that popular of a sport, so it's very rare to find on TV. But with FuboTV, I've actually been able, well, when I had FuboTV, I don't have it anymore, I was able to watch both Major League Lacrosse and Premier League Lacrosse, which just recently merged, which was, again, very exciting for me because previously I was never able to watch lacrosse on TV. But enough about the content. Probably one of the biggest things that I like about FuboTV is that they do have 2 sources of revenue currently. The first is obviously from their paid subscribers, which they currently have around 455,000 paying accounts, which is small when you put that next to companies like Netflix, Hulu, and even Peacock for that matter. But it's enough in a niche market to be a substantial portion of it. Currently, their paid subscribers are averaging around $53 million a quarter in revenue, and that is actually up around 64% year over year. So that is an increasing number, and their paid subscribers have also been skyrocketing over the past year. And unlike Netflix or Disney, though, they also do have ads, which I know as the consumer is something we don't always enjoy seeing, but as the investor, I do like seeing that because while it's only a small portion of their revenue, it's still extra money flowing through this company, which, as we'll discuss in a minute, is something they desperately need. Their ad revenue only brings in around $7.4 million a quarter. Again, small, but still enough. And even that is up 153% year over year. So the ad revenue is clearly an area of opportunity for them, and one that we'll probably see expanding and continuing to grow in the next few years. Also, probably the thing that stuck out to me the most about this company is when you look at one of the few metrics they have, which is a free cash flow or a discounted free cash flow analysis, they are very undervalued. If you look at the numbers from Simply Wall Street, we could see that they're trading around $62 a share. I actually think right now it's around $54 a share, so a little bit of a drop. But the free cash flow analysis says that they should actually be trading, or their fair market value is around $170 a share. And I think they projected this out to 2030. So basically they're saying that the share price in 2030-ish range should be around $170 a share, giving it that 63% discount. Now, I should say that is not a guarantee that they'll actually reach that $170 a share, but it does give me some hope looking at this company as an investment without that much other data to really fall back on. And I did forget to mention, they do have a potential third stream of revenue coming their way. Earlier this year, they purchased Balto Sports, which is a sports betting platform. And that's something that they're going to incorporate with their streaming service, which I think is a brilliant idea because as you're a sports-focused streaming service and really in that niche area, sports betting really goes hand in hand with watching sports, and it's becoming more and more popular. In fact, it's actually expected that sports betting will be a $155 billion industry by 2024. So clearly, this is something that if they're able to capitalize on, could be a great source of revenue. Now, that is a fairly new deal, so we don't really have any information on that. Some things that I'll be looking for personally, though, is this going to be a source of revenue for them, or is this just going to be an incentive for people to come to their service? And if it is another source of revenue, how are they going to make money from it? And how easily accessible is it going to be, as well as any restrictions? Because not every state in the US does have legal sports betting. So something else to bear in mind. But I think with Barstool Sports always promoting sports betting, it's probably going to be a pretty popular option for FuboTV. But now let's go ahead and move on to what I don't necessarily like about this company or what I think some potential threats are for them. So what I don't like, and it's kind of the usual for companies that you've heard me say in the past, but always just worth bringing up in case you are new here, is they are a new company on the public markets, meaning we don't really have that much financial data to go back on and really see how well this company has been growing over an extended period of time. For that matter, they're still a really new company. They're only around 5 years old, and it's only been 3, almost 4 years since they've incorporated sports other than soccer. But that goes to show they're not profitable and they have a bad balance sheet. Now, I know mentioned earlier that there's not really too many numbers to be looking at here, so we don't have like a PE ratio or even really a price to sales ratio that would be reliable. But I can show you how to do the current ratio for this company just using some loose numbers here. So again, this is from Simply Wall Street here. And to do the current ratio, it's a really simple thing to calculate. It's basically your current assets divided by your current liabilities. Obviously, for those, we like to see those usually over 1. Not all industries really allow for you to be over 1. But when you have a current ratio over 1, it just means that you have more assets than liabilities, which helps strengthen your balance sheet. So let's take a look here at the short term. Short term and current really can go hand in hand for the most part. So ignore the fact that it says short term and I'm using current. So as you can see, their short-term assets is around 58 million, where their short-term liabilities is around 247 million. To get your current ratio out of that, all you would need to do is really just divide. I would just do 58 divided by 247, and that got me around 0.23. So that is a pretty atrocious quick ratio. But as I've said in previous videos, content is not cheap. And it kind of pains me to say that because I have not gotten paid to make a single one of these videos, but maybe that'll change one day. But owning content is not cheap, especially with sports. Sports is actually one of the most expensive forms of content to get the rights to show because, I mean, there's just so many reasons why it's so expensive. So I don't expect this company, being such a new company, to have such a stellar balance sheet. So that's actually something that I can get past. But what I do want to see in the future, because they are holding on by a thread right now, and I think one false move, this could be the next Quibi, and they could go out of business pretty quickly if they aren't very strategic with how they move forward in the future. So something I would like to see is their cash flow start to increase, whether that be through more paid subscribers, additional sources of ad revenue, or hopefully from the sports betting can create another source of cash flow for them, because that's what's going to help them really reach profitability. I also want to see those liabilities start to go down sooner than later, obviously, because that again is just going to raise that current ratio, which should help them leverage debt should they need it in the future. Right now, I'm sure a lot of lenders can look at this company and see how low that current ratio is and not want to lend to them because that is high risk for the lenders themselves. So something to bear in mind, but those are some factors I'll be looking out for. But it's not really enough to steer me away, kind of given what I was just saying about content. But there is one other concern that I have with FuboTV right now, and that's their lockout period. Now, we kind of talked about the lockout period when Palantir went public, but I'll just touch on it again. So when companies hit the public markets, a lot of times they'll have what's called a lockout period, which basically means insiders at the company, so your CEOs, COOs, board members, all of them, can't sell out of a percentage of their shares. Usually it's like 70 to 90%. For a certain time frame. Reason being is because if all investors sold out immediately, that would just cause the stock price to go down, which can hurt the company. So they lock up those shares for a certain time to let the public markets have their access to them before they let the insiders start selling. Now that lockout period is set to expire sometime in January. I forget if it was the 13th or 31st. But when that happens, there's a chance that a lot of insiders could be selling out of this position, which could drive the price down. If that happens, it could just create a better buying opportunity, but it also might speak to the direction of where the insiders actually think this company is going. So that'll be something that I'll be watching out for because, again, it could present a good buying opportunity for the company. On the flip side of that, though, if a lot of investors hold on to their shares, that could show that this company is headed in a very strong direction and might still be worth holding on to. So if the investors don't sell out of it, then odds are that stock price is going to continue to go up and up and up, meaning that maybe we missed out on our buying opportunity. So overall, I have to say, this is a tough company for me to add to the portfolio. And I think maybe for the first time in Watchlist Wednesday history, this is something that I would truly say maybe just to add to a watch list, not necessarily go out and buy today. Not that I've ever said go out and buy today because that's advice and we don't give advice on this channel. But there's a lot of uncertainty with this company, and maybe even too much for me to say that this is definitely a stock worth adding to your portfolio. Now, that said, I already did add this to my portfolio, and actually, full disclosure, I added this to both the Watchlist Wednesday portfolio and my own personal portfolio, but I bought this stock actually a few weeks ago when it was only $20 a share, so it's done pretty well for me so far, and one that I'm going to hold on to and kind of ride this wave to see what happens. But let me pull up the Watchlist Wednesday portfolio so we can kind of take a look at that together. All right, so I did buy around 100 shares of FuboTV, which yesterday was around a $5,500 purchase. It's right now at a $5,595, so we've only made about $20 off it. And actually, if I'm not mistaken, I think we've probably lost money by now because I'm pretty sure that stock price has gone down a little bit. But it's, again, something that maybe I would say hold off on right now or maybe wait until this lockout period. But as always, do your own research to see if this fits well into your portfolio. Now, just to take a look at some of the other stocks we have, obviously iHack and Zscaler are both doing pretty well for us. I kind of expected Zscaler to be a little bit of a better performer than iHack, but both of those are still green. So I'm happy to see that. But then we could see BlackBerry and Comcast are only 2 losers now, which is okay for me. I'd rather have more positive stocks than losing stocks, and you're not going to have winners 100% of the time. So only 2 of the whatever many we have in there is okay for me to see. DR Horton started to turn things around though, which is good. Same with Smile Direct Club. I'm happy about both of those. And Etsy, ARC, and ChargePoint. Those 3 are really leading this portfolio very well, so I'm happy to see that. And Pinterest is finally starting to turn around as well. That one was staying around that $500 gain for a while, and now it's up to $730. So it's good to see that one is flipping the switch as well. So I do apologize if this is not my most detailed video or most informative one that you've ever seen. Like I said, I want to do something a little bit different since this is the last one of the year. Maybe it wasn't ending on necessarily the strongest note, but it was a little bit risky. It's a little bit different, but if this one pays off, then it's going to be a huge boost to our portfolio. And it's one that I wanted to talk about sooner than later because they do have a lot of upside potential that I'd rather put on your radar as soon as I can than hold off until, well, it's too late. I hope that you enjoyed this video. Please let me know if you have any questions below, and if you want to do the Webull thing for the 6 free stocks, check out that link below. Again, it does expire today, December 23rd, 2020. So if you want to take advantage of that, you'd have to do it today. I'm not saying you have to, but check it out. If you like this video, hit it with a thumbs up, and if you want to subscribe, certainly feel free to do so. It'll be a nice little Christmas present to me, and guess what? It's free, so you don't have to pay me anything for that gift, and it's one that I'm going to be very appreciative of. For next week, I know there's one more Wednesday left in the year, but for next week, I just wanted to do more of a portfolio review and talk about my favorite stocks that I've picked and also some of my least favorite stocks that I picked throughout this year. So let me know if you have any questions for me that you'd like for me to answer next week. It's going to be a little bit less formal than these videos typically are, and they don't have to be about investing. You can ask me some personal questions if you want to, and I'd love to be able to answer some of your questions and put them up on the screen and kind of engage with all of you a little bit more than what I typically do. So leave any questions you have on the comment section down below, and I'll gladly answer them next week during next week's video. With all that said, though, it is the day before Christmas Eve. I have not wrapped a single present yet, so I've got a lot of work to do, and it's kind of a busy day still. So I'm going to let all of you go ahead so I can move on with the rest of my day. Thank you so much for taking the time out of your day to watch this video. You could be anywhere in the world, and you're right here with me, and I really appreciate that. But I'll let you go ahead, enjoy the rest of your day, and to all of you, Merry Christmas, Happy Hanukkah. Sorry I didn't say that sooner. I know Hanukkah's been going on for a while. It might be over by now. And I apologize that I don't know that off the top of my head. But I hope everybody's been having a great holiday season, and we'll see you next week before the end of the year. So until then, take care.